Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economics update with our friend Martin North. So how are you, Martin?
I'm pretty good. It's very wet here today, very cold, and some of the technology is not working. So it's all great for Friday.
Oh, look, we go to great lengths to get people these episodes every month. It's been in the negatives every day down here in Tassie, and we got 3 or 4 inches of snow on my front deck, which a few of you saw on
Wow. Yeah.
Facebook and Twitter, which Louis and the dog loved. So Henry, the Bernese Mountain Dog, was back in his element this week. But I guess one thing I just wanted to mention, Martin, before we get into it all as well, was thanks to our audience for sharing these videos, because a little while ago we were getting 50 plus thousand views on these, and the YouTube algorithms really, I guess, cracked down on us. And sometimes when we're talking about COVID or property or banks, whatever it is, it's trying to suppress this type of content. So, guys, if you
Yes.
can share this with your friends and family or groups, people that you think are interested in this, they're no longer going to find it by searching for it, which is a bit of a shame, but it's only getting sort of 20,000 views, and we know that it was getting consistently 40 or 50 before. Have you experienced that on some of your videos, Martin?
Absolutely as well. Yes, it's a lot harder than it was to be able to get the content out there.
Mm.
The algorithms are definitely throttling, and it's not just me; it's a whole bunch of people working in the same space. So yeah,
Mm.
they've definitely done some stuff to make it less available,
Ab-
unfortunately. So we need to rely on the social systems and also the followers to share and comment and do all those things to help us get the message out. Because I think there's almost a bit of a sort of a we don't want to get this out too much sort of thing going on at the moment, unfortunately.
Yeah, like we're talking about in the pre-interview, a little bit of almost like a sort of silence or treading water, where people know there's literally a sort of fiscal cliff that we're going to talk
Yeah.
about that we're getting to as well. But it's not nice to talk about, because property's only ever gone up, and we've been saying, well, maybe if it comes back 10 or 20%, the fact that people are over leveraged, this can get nasty. And now we've seen the impact on jobs, and the economy starting to flow through. And education is the way that you avoid these things and protect yourself and your family. So we want to get these messages out there.
That's right. And the sense is the fuse is burning, right? But the trouble is that many people aren't seeing the fuse and they aren't seeing what could happen once the thing goes off.
Mm.
And there's clearly a wish to try and keep people from knowing the truth, I think. So I think the role of social media, and particularly the sorts of channels that we get involved with, are really more critical than ever before for people to get more informed, and then they can make better decisions.
And I guess the general backdrop, before we dive into the slides of what's happened in the month since we've spoken, it's been not really a second wave as such, but more of just a fear of that second wave getting worse in certain areas or countries. But it's been I guess, the economic wave that's become a reality for people, rather than this bridge to the other side in a few months. We're now 6 months into this, and whether it's some of the doctors or people's businesses, they're kind of saying, well, where is the light at the end of the tunnel here? And that's hard mentally for people, but also financially, and all the data we're going to get into.
Yes, I mean, I don't think anybody's now talking about V-shaped recovery, even in the US, right? This is going to be sawtooth shaped at best, up, down, up, down, up, down. And the social and economic consequences of what's happening is going to echo down for many years. And I'd make the point again, COVID was the catalyst to underscore the significant issues that have been around for a long, long time in the economy, and everybody didn't want to talk about them.
Mm.
Now, of course, they have to talk about them.
Yeah, I mean, they were setting it up to blame the bushfires at one stage, and central banks were talking about saving us from climate change at one stage. So there's always going to be the catalyst and the blame, but these
Yeah,
issues were underlying.
absolutely.
I'm assuming you've got a very special show, Martin, when the top 10 slides are 16 slides this week. So,
I know it's inflation.
well,
I
well,
did put quotes around them. I couldn't get it down to 10 because there were just too many important things. But we'll go through them relatively quickly.
the more the merrier. I love it, Martin. So first up here, I like the fact you've started with this, because one thing that I've been trying to make really clear to my viewers over the last few years is that you have to disconnect the markets from reality, and don't get frustrated by it and sit there and wait for everything to crash and burn, because they're pumping money in and they're trying to push things up, and that has created definitely a bubble in sectors, in my opinion, and we are seeing it now clearly with the rise of these Robin Hood social, day trader Dave picking out. Have you seen the Scrabble letters he picks out and just buys that stock, and everything goes up that day? And these are the numbers you've got for us here.
Yeah, so it's really interesting, and this is data both from the US and from Australia. So, firstly, people need to understand a lot of the trading that's going on is program trading, algorithmic trading, right? Which of course accentuates all of the liquidity movements and the trading movements. And in fact, the chart there on the left shows you that really it's all about automation. It's all about automated trades. So when you think about going into a market, whatever the market is, you're competing with computers, right? That's quite new. It's been going on for some time, but the relative volume is just massive. And then the number of new traders coming into the market, mum and dad traders or whoever, the people who got their check from the government and decided to put it in the market has gone through the roof. So the data at the top there shows you some of the online accounts that have been running at massive growth levels in the US. And the one at the bottom is from ASIC. ASIC was has actually put out a number of warnings to say basically got to be really, really careful because there are a lot of people who are reactivating their trading accounts and are trading. The question is, which is what ASIC was trying to get at, was do they know what they're doing, right? So my general position is if you talk to a lot of professional people in the marketplace, they're much more cautious about what's going on. But the fact is that many, many people are buying and they feel though this is the easiest way to make money because the markets have gone through the roof in the last 3 months and whatever asset class, whether it's Bitcoin or gold or whatever, isn't it easy to make money? Just remember that for every buy, there's a sell. And what that means is that if you make money, somebody else is losing money. And the question is what's going to happen as this thing goes forward. So be cautious and be careful. And on the next slide, if we go straight to that, Alex, then ASIC has put out a warning and basically said it's really, really difficult to time the market. Professionals don't necessarily do it. And they've highlighted the massive run-up, for example, in real estate trusts in Australia at a time when the value of those real estate trusts are going down. So there's a lot of conflicting signals, but my takeout from all of this is many, many people risk getting burnt now because they're assuming the market is going to go on running. Many people are putting their checks from the government in, hoping they'll make some money. High risk, know what you're doing, and just be really careful.
Yeah, so we've seen things like really clear data. The amount of people buying $1,200 worth of Bitcoin or Ethereum spikes when the government are giving out these checks, which is something interesting we might get to later as well. But the other thing I want to mention here is you look at the grey line for the machine trading versus humans, and it's 90% machine dominated when markets were functioning normally in, let's say, mid-2019. One thing we've always warned about is the collapse of that liquidity, and the trading bots and the algos, they're all going to get pulled when things go haywire and they're not used to that environment. And then you look at it there and the spike in retail traders, and now it's almost a one-to-one in terms of what was happening when the markets were crashing. So if we have another downturn, it might be very little of these bots and very little liquidity and a one-to-one relationship of retail traders, which is nuts to think about that they are now sort of moving markets.
That's exactly right. And, the markets are not logical. They're probably significantly over long-term value. Nobody quite knows. But things will change quickly and people risk getting caught in this environment.
Yeah. Something else I just want to point out is we're always trying to educate people on who's on the other side of the screen, as you said, Martin, when you're acting emotionally and trading. And things like real estate investment trusts that are packed with these rental properties or whatever it is, they're not liquid markets. They're not easy to sell. And that's where we've already seen some issues in the Australian system where there's been some forced sales. And people want to buy gold, for example, and they go out there and they look for this triple leveraged gold ETF and they get these funky products which they don't understand how they work. They don't always operate as you thought. You might not be allowed to own them in your super or whatever it is. So just be so cautious, guys. People are getting themselves in a tangle, and that's why you hear stats like 90% of retail traders lose money. So, yeah.
Yep. And unfortunately, a lot of the professional investors have better information, quicker turnaround times, and so often retail investors get left on the side.
And the professional investors are paying big money at the moment for the data on what the Robinhood retail traders are doing. So they've got the edge over you guys for sure.
Correct.
Absolutely. Okay, Martin. So next up, this is an interesting one. What's the fair price of gold? And I think we've both been talking about these real interest rates. So the fact that the Fed are talking about, we need more inflation, but they've got interest rates at zero. So you then say, well, real interest rates are negative, and this has been a big driver of gold.
Yeah, I mean, it's just tricky. Gold's been running up and silver as well. And, there are a lot of people talking about gold will go to, 4, 5, 6,000, which it might do. But this was an interesting thing that I found. There's a fair price gold model from the City of London. And what this highlights is that actually there are some critical factors which, right, real interest rates, obviously, the speculative premium and what inflation is doing. And based on your assumption about where those things are going, you could actually argue that the price of gold in real terms should be much higher than it is, but you can also put different parameters in it and go a lot lower, right? And in fact, their fair price model is below where the current market is. And they did make the point that, often gold will go above fair price and then come back. But this has tracked quite well over the long term. And the point I want to make is there are lots of different elements driving all of this forward. And therefore, it's quite complex to try and understand what fair value is. And it's important to ask that question from time to time, particularly when markets are running up.
Yeah, and I would just caution people that we're now starting to see, like crypto YouTubers jump on the gold and silver bandwagon, and the time to be buying or accumulating was any time in the past 20 years. I think it was it Goldman the other day, one of the analysts put out a buy recommendation on gold, and it's funny how all these people are experts in telling you to buy now that we're at $2,070 as we're recording, and that's probably when the smart money again is starting to take some profits or just be wary of a pullback. So guys, just be cautious of those things again.
Yeah, exactly right. And don't take everything on face value. Do a bit of homework and dig down. And I guess, Alex, this is part of the broader question in terms of money supply, right? Which is actually the next slide, because what we've had is a massive run up in liquidity, right? The central bank here in Australia has been putting money in the system. People have been drawing out their superannuation. The government's been making all these payments, JobKeeper, JobSeeker, etc. Right? And so we've actually got a 10-point-something% rise in liquidity in the system. Same in the US. Same in most other countries. And the critical question now to ask is, where is that money going, right? Because a lot of that money early on was actually flowing directly into the financial markets and the financial system and allowing corporates, for example, to issue bonds. But we've started to see a change. It's flowing more now into the retail system. In other words, expect to see price rises on things because supply demand suggests that might be the case. This is an important signal to watch in terms of what happens from this point forward. So for me, these liquidity questions are becoming really critical.
Yeah, and we've both done episodes about inflation and how CPI is measured versus the reality of the cost of living. And if you start to go down this path of actual money printing and money creation being 10, or in America, I think at one stage it was 28% annualized when they did all those trillions. That is super, super dangerous. And when you hear things like, oh, we're going to have to cut back on the meat production in Australia, or supermarkets may be starting to get scarce in some areas. Now, they're hopefully going to change the supply chains and logistics, and there's going to be enough food. No one's going to be going hungry in Australia anytime soon. But that's when you can start to get less goods and more money and go down that inflationary path.
Yeah. And, we've said before and we'll say it again, there is an uncertainty about the future. Will it be inflationary? Will it be deflationary? I think there are many people saying it will be inflationary. I just come back and say, well, just be careful. It might go up for a bit and then come back as the broader deflationary impacts of what's going on play through. Difficult to tell. Watch the money supply, though, as an indicator of which way it might be going.
Yep. Next up here, Martin, you've got some APRA data, and we've been watching all the loans and who's deferred, and the banks are saying that these are still good mortgages because they're on hold, and that is another thing that's coming at us down the pipeline, isn't it?
Yep. So basically, we've got between September and January for the bank to contact all of those people who had interest in principal deferments on their loans, business loans or mortgages, and they've now got to ascertain whether, in fact, they will be able to get those incomes back to service those loans, or whether those loans will have to be declared bad at some point. Now, APRA may extend that because of what's happening in Victoria, but we've got a significant proportion, about 10% of total loans outstanding, about 11% of mortgages, 17% of business loans are actually not performing, actually. And so at some point, this is going to come back and hit us, because we're not going to see this V-shape, as we said earlier on. So these bad loans are actually significant. And in fact, Morgan Stanley said 55% of people with loans at the moment are getting some support, either from JobKeeper, JobSeeker, wherever, right? So this is all going to change going forward. So we need to watch these numbers again. This is a really worrying stat in my mind. And at some point, the banks may have to start declaring these loans as bad. If they do, they'll need more capital. That will restrict their lending capacity as well. So this is a really important statistic.
Yeah, I had one of my friends who's a hedge fund manager reach out to me when I shared that piece about 55% of Australians need to find a higher paying job in the next 6 months or blah, blah, blah. And again, I think that was kind of stretching the data, but what it was saying was that 55% of people have received some sort of support or stimulus. And if that goes away, then in theory, these people need to cut either spending from the economy or mortgage or whatever it is. So, yeah.
Yeah, it's a big deal, and we'll talk a second about the cliff, which has moved slightly, but it's still a cliff, right? But let's touch on super, because of course the other thing that's happened is the superannuation, and they've now said that they expect a larger pool of super to be drawn down. The latest data was, 29, 30 bill, I think, but they're talking it could be 40 bill plus. That's quite a significant number, but that is a one-time sugar hit, right? So, a lot of people are sitting on that money. A lot of people have put it into savings accounts at the moment. Others are spending it. Others are putting it as a deposit for a house. The question is, will they allow this to continue? And there's a big debate about, are we actually degrading the super system? And many people who pull the money out are younger people who essentially are missing the compounding effect of investing now and taking the value in 30 or 40 years' time. So we've got to be careful that we don't effectively cripple our old age in terms of trying to get through today. But on the other hand, I can precisely understand why it is if people are actually struggling with cash flow, this looks attractive. But we also know that quite a few people who've taken money out didn't need to. So this is a big deal.
Yeah, so two things I want to add here is, again, who's on the other side of the screen? If you're a young person and you're a forced seller, you're selling your assets to someone who's wealthy and in the markets, and they're increasing their assets at a lower price. But then it becomes twofold. So as Martin said, you don't get that compound growth of these assets over time. When you get to retirement age, the government, instead of giving you $10,000 now, over 30 years, that might compound to, say, $100,000 or whatever it is. And they're now having to foot that bill for 100,000 instead of coughing up 10,000 now. So it's a double-edged sword in that regard too.
Absolutely. And this is really, really tricky because a lot of people with lower incomes, a lot of people who are younger are actually getting most caught here. So we've got to watch this very carefully.
Yeah. All right, household confidence. So we had that big jump when we all thought that V-shaped recovery was on the cards, and now it's drifting lower again.
Yeah, drifting lower and consistent with my data as well. And all I make the point here is that confidence is important because if you are less confident, you're going to spend less. And the lockdowns and the state border restrictions are all having a significant negative impact. We're seeing it also on the business side as well. So I think this is an important, again, indicator that this is not going to be V-shaped. This is going to be a long, slow drag. And, whatever you say about this, we've got to assume it's going to be 2 or 3 years. So we've got to sort of plan for the long term.
Yeah, sentiment drives markets, and there's still a little pocket, I guess, in the property sector where people are saying that it's still hot and there's still demand in some areas. But I just think that you're sort of reaching that tipping point with the general public where there's not people out there now that are saying, oh, property's a great investment that's always going to keep doubling. There's starting to get a little bit more uncertainty out there.
Yeah, I'm afraid that's right. And what I'm finding is the SME sector, specifically the small business sector, are really now, about 1/3 of them are looking really, really shaky on my data. So we'll watch that ahead.
And that's not to say that all property is a bad investment. If you're a smart property investor, you might say, well, look, people are really going to want to move to this region here because of A, B, and C. So it's, yeah, I always like to try and give a bit of both sides.
And I always say it's not one property market, it's multiple markets, multiple locations, multiple dynamics, and people need to get granular to really understand what's going on. Those high-level indices don't tell you very much at all, particularly now.
Yes. Unemployment, that's trending down, Martin. But again, we've got these cliffs ahead of us, which are the real story.
So this number is before the latest lockdowns. I think the Reserve Bank's now saying unemployment's likely to be 10% rather than 9-point-something%. The real unemployment rate's a lot higher than that. The underemployment rate is higher. These are importantly high numbers, and nobody that I'm reading now is suggesting this is going to cure itself in the next few months. So again, part of a 2 to 3 year correction, as I often say, you have to go down the escalator when employment increases, but to actually climb up the stairs takes a long, long time.
And what did unemployment peak at, Martin, official data in the recession we had to have in 1990?
Well, the difficult years, they measured it differently. So it's really not very comparable. On a comparable basis, I would suggest that the rate of unemployment is now looking as that will go higher than it did back then.
Okay. Retail turnover. So a lot of the people that have gone back to the jobs, the cafes and the restaurants that we thought were going to be okay, they're now the people that are being laid off again.
That's exactly right. And so we're seeing big swings between different types of things that people are buying. So there was a lot of office equipment being bought, and home entertainment, those sorts of things. That's changed a little bit, but overall, retail is actually not too bad if you look at it in sort of just turnover terms. But if you look at it in the total value of goods, it's not looking so good. I'll also make the point that online is still very high. So we were actually, up at 14, 15%. It's come back a bit, but online is still now very significant. And given the now new lockdown in Melbourne, you'd assume that online will continue to grow.
Yeah, I definitely think people are trying to make a bit of a conscious effort to support local for the little cafe that's pivoted to deliveries only, and that's the sort of, buying some more clothes because you're at home more. So they're the sort of retail spending things that I see.
Yeah, I agree. And it's interesting that, some variations across the states, but I would expect the data ahead in Victoria to be particularly troublesome now.
Yep. Okay, so here's the big stimulus cliff. It's around $100 billion, isn't it? If we round up a little bit here, what we're looking at it dropping off in Q4.
Yeah, so I put the extra 15 or so billion that they've announced through JobKeeper into the Q4. It might be slightly earlier, but the point is, we know that the settings they've currently got, the stimulus is going to be withdrawn to an extent, and nothing is really fixed yet. So the problem I have is that we've probably got significant fiscal drag even now, and my suspicion is the government will have to do more. They will probably have to keep a higher for longer, and I'm not sure that job seeker will actually go the way that they suggest. They're still tied to this doctrine of we need to get the spending down really quickly. My argument is I think in this current environment, we will need more government support for a lot longer to keep our economy at least ticking over until things begin to recover. Without it, the situation is pretty dire.
Yeah, and even just like being more open to it. If you're someone at home that knows that you're going to lose this support and you've got nothing to look forward to, it's so frustrating that, as you say, the government is so worried about this debt, whereas I think we need to have these conversations about short-term modern monetary theory or whatever you want to call it. It's not going to be inflationary when all these people are losing their jobs if you're just giving them something to live off and to keep their rent flowing, just to keep the economy ticking along, versus, no, we need to save money, bad luck, and people go, well, where's my next meal coming from?
Yeah, and I don't think Frydenberg helped when he started summoning up Reagan and Thatcher and talking about, that's what we should go back to. No, we need a new path, we need a new way of thinking about the economy. As we said many times before, how do we stimulate the investment in the local economy here going forward? How do we create the new jobs that we need, not just reinventing the old jobs? Some of those policy settings I still think are wrong, and unfortunately there's myopia amongst the parliamentarians and maybe even amongst the Reserve Bank and elsewhere. There has got to be a different mode of thinking ahead to be able to manage this. And it could become an opportunity if we're careful, but it also has huge risks now.
And I think something we haven't maybe spoken about specifically is if we start to get deflation in the local economy, there's less of a pool of money, the size of the economy is shrinking, and if we're still trying to divert resources to saving property in the banks, that's even fewer and fewer, and making the resources that are going to creating new jobs and innovation and technology, that's making that more and more scarce and rare. So that's not what we want.
Correct. They should have put home builder into other things, in my view. And the problem is that the longer they go on trying to support the property sector, the less able you to invest in things that will actually take us to a better future. And that's what I'm concerned about. The strategy is, as I say, myopic and rather elderly. And interesting, the RBA published a paper the other day to say what we need to do is just to build smaller skyscrapers in Sydney. That will solve our problem, right? And I'm thinking, not sure that's true.
I think that was Dr. Tulip, wasn't it?
It was a fantastic name, right? Given the fact we had the tulip bubble, many centuries ago. Unfortunately, rather myopic in my view in terms of understanding how things work. But it was an interesting paper, but I worried by the conclusions.
Well, I think Steve Keane told me Dr. Tulip wrote a paper about how Iceland had the most stable banking system, and that was a few weeks before they collapsed in the GFC. So,
well, and in fact, if you take his assumptions and apply them to those countries at the time of the GFC, you'd have still been said property is really cheap when, of course, it dropped 40%. So, no, unfortunately, they're missing credit. They're missing the fact that you can't go on taking interest rates lower, so therefore the affordability sort of formula no longer works. Unfortunately, it doesn't tell the full story, and I'm worried that people say, we just build higher properties and that will solve all the problems. No, it won't. We've got plenty of supply of high-rise apartments in most of our major centres, particularly in Sydney and Melbourne.
Yes. Well, something that is rising still, Martin, is mortgage stress, which is it's to be expected.
Unfortunately, it's as expected, as predicted. It's running with my projections, 40.2% of households, so that's 1.5 million now. That's on a cash flow basis, money in, money out, and that's taking account of JobKeeper, JobSeeker, all those other things. The fact is, we have lots of people under financial pressure now. If things bounce back quicker, then this could come down again. But the longer this goes on, the more structural this becomes. And we're seeing now more households saying, well, we may have to think about more radical moves. The bank are picking up the phone and saying, well, you may need to think about selling. So I'm still expecting property to come onto the market later in the year. And in fact, the listings numbers are higher than they normally are at this time of the year, even now. So we have a disequilibrium in the property market. We have a lot of financial stress there. And unfortunately, I can only see it's going to get worse ahead.
Yeah. Okay, so state by state, Tassie tops this list.
Yeah, that's right. So I just sort of sorted this mortgage stress by state. Tassie at the top. It's a small number, but it's still very high, and that's because of some of the economic fallout, but also the fact that you had a big run up in prices previously, and a lot of the mortgages that were being written were quite high relative to incomes, which tends to be a bit lower in Tassie, and then the Northern Territories, and then Victoria, as you'd expect, and interestingly, Queensland and New South Wales are doing relatively better in terms of mortgage stress, and that's partly because of the fact that in Queensland prices didn't run up; they've been going sideways for a number of years, and in New South Wales, if you take the whole of the place, there are some areas where things are a lot better than others, but unfortunately, this is not good news, and you can see there that the 1.5 million, there's a lot of households, and a lot of people will be hunkering down, spending less, drawing perhaps down on credit cards if they can do that, or using deposits. But this is not good for the broader economy.
And just again, to tie this to the changes that we're seeing, the shifts in banking and assessment of their risks, they've really changed what they're looking for now from your assets to your ability to service and your wage. So they don't care if you have 5 houses in Tassie anymore. They're actually starting to price in the fact that they could fall 10 or 20%. They're saying, can you service that loan with your wage? And Tassie's very reliant on the tourists, that kind of thing, which is now completely dried off. And that's why I think there's room to the downside in Tassie as well, even though it's a lower base.
And that's why I think mortgage stress measured on cash flow is so critical, because that really gets to the heart. That's how the banks are thinking about it now. So you're absolutely right.
Yeah. All right.
We also did the same on rental stress, the same issue, cash flow, 1.7 million. New South Wales has the highest proportion there. That's partly because rents have been higher there. It's partly because we've still got a lot of people who've lost their jobs or have much less income. And in fact, it's New South Wales and Victoria. And interestingly, a lot of those are actually in inner city areas. So, for example, Melbourne 3000 has the highest rental stress in the country.
Yeah, I'm actually surprised that Tassie's so low in that rental stress compared to mortgage stress. But
yeah, it's it changed a bit. It was higher last time, but actually, I'm assuming that the local economy may have opened a little. I don't know, but yes, that's where it is on the list today.
Okay, so property investor stress.
Yeah. So this is the third angle. So I've now taken the mortgage stress analysis and also thought about property investors. Now you have to look at property investors differently. So I look at where they live rather than where their property is, and I take account of things like, is the property vacant or not? What's their cash flow like? Are they trying to sell it? And other factors. But nevertheless, this is a big deal. 25% of property investors are stressed on my definition. In other words, they're not having sufficient flow of funds to be able to service what they need to service, and that includes the mortgage, but also the rentals and repairs of the property that they're actually renting out, right? And unfortunately, 34.4% of investors stressed are in New South Wales. That's right at the top of the list. Then the ACT, and then you go down the list. Tasmania, the least so, interestingly. Again, I think it goes back to the property formulation in Victoria was very different, for example, in New South Wales, different from Tasmania. I suspect we might see that rising ahead, because property prices in Tassie look to be beginning to plateau back now. Whereas, of course, they're already moving down in some parts of New South Wales, so there's an equity problem. And interestingly, about 12% of property investors in the surveys are now saying they're considering exiting to an extent from property. Quite a few of the people at the top end here have, like some of them affluent ones, have multiple properties. They're not going to get rid of their total portfolio, but they're going to get rid of some of their portfolio. So again, another reason why I think that property is going to be very much coming on the market over the next few months.
And this is why we've seen the banks start to give out more or extend, I guess, even interest only and things that they weren't necessarily wanting to do, or that the Royal Commission was trying to stamp out, bringing these other changes in. Well, we're going to have to let these things go for the time being.
That's exactly right. And the banks are tightening now, particularly if you've got a lower loan to value ratio, particularly if you haven't got the evidence to show that your income is on the way up. And I suspect there will be some very painful phone calls over the next quarter as the banks start moving from September to January. As I said, they've got the extra 4-month window. But if this data is anything like right, and I'm very confident now in the data, we've run in this methodology for a long, long time, there are many households with financial pressures. And in fact, other people like the Melbourne Institute published research recently that also underscored the financial pressures that people are under. And this basically suggests that whether you look at investors, whether you look at renters, whether you look at mortgage holders, all of them are wrestling with cash flow issues. Not good for confidence. Well, that's why confidence is down. Not good for future economic activity because they're going to spend less. And so you have to stand back and think about this holistically in terms of what does that tell us about the economy going forward.
So, winding it all up, Martin, your scenarios, what has changed here? Is it the same as last time?
Yeah, so a little bit of a change. So basically, I think the original RBA baseline scenario of a V-shaped recovery and nothing too much to see is definitely off the agenda. I've only given it a 2.5% rating now. I've increased my longer-term crunch scenario, which is basically talking of property prices somewhere down between 15 and 30%, depending on where you're looking and whether you're looking at houses or apartments. So more downside than upside risk on property. Most of the property commentators, not all, but most, have now swung over to the negative side, and some of them are saying 10%, some are saying 20% or more, interestingly. And there are all the property bulls who were really roaring 2 or 3 months ago have gone very, very quiet now. It's not certain. Things could change again. But I have to say, I think the chances of property values rising through this year and into next is pretty much zero now. And the question then is how far they fall, which properties are going to fall more, units probably more than houses, different locations, different parts of the country. And I'm doing quite a lot more detailed modelling now to try and get more granular, to try and predict where those pain points are. But just to make a final point here, Western Australia, which had already dropped more than 20% in the last quarter, dropped again. So, don't think that WA is somehow isolated, right? Even over there, things are still looking pretty bad. In New South Wales and Victoria, where prices were very high, definitely a problem. I think Tassie, probably, a little bit more support for a little while. Adelaide, probably the same, and South Australia more generally. But I am concerned about the major states of Victoria and New South Wales. I worry that they will follow the trends that we saw in the West over the last 4 or 5 years. And remember that in the West, some postcodes there are down 38% from peak, which is scary thought. But remember that property, compared with long-term neutral settings based on income or GDP, are 40% on average, 40% overvalued even now. Mm-hmm. So there is still plenty of opportunities to come back to the long-term trend. So it's somewhere between 0 and 40%. And as I say, I'm picking somewhere between 15 to 30% on average.
Yeah, and with the borders being closed clearly until next year, that really closes down the tourism, immigration. I'm wondering if we're going to start to see more young people move back in with their parents like we're seeing in other countries. They're the things that are still playing out that I just don't think they're being factored into the government's numbers of how much support they are going to have to give without things getting nasty. And you can keep stock markets high. You can tell people that property values are still high. But once you get to that threshold of 25% youth unemployment and people start to get sick and tired of being told they've got to stay at home and these sort of things, the cracks can appear.
Yeah, I think that's the point. What I say to people is, get informed, understand what's going on. Just don't believe the high-level propaganda from the mainstream media or else. Find out what's going on locally, but also be cautious and don't overcommit. In this environment, this is a time to just be very, very careful because there are many, many uncertainties.
Well, guys, if you can share that around, comment, that does help get the message out there. That's been one of my favourite episodes, so I really appreciate that, Martin, and we'll have to catch up again next month.
Good to talk to you. Take care.
Thanks, guys. Cheers.